Hello, I'm Andy Agathangelou, the founder of the Transparency Task Force. We are a certified social enterprise, which means that we exist to make an impact, not to make money. Our purpose is to promote ongoing reform of the financial services sector so that it serves society better. And our vision is to build a highly respected, and for me personally, those two words are very important, a highly respected, international, influential institution that is dedicated to helping ensure that consumers are treated fairly by the financial industry. We're UK based, but we operate in 21 countries around the world. Most of our members of course, are in the UK, but we've got a fast growing community in the USA, Australia, Singapore, Hong Kong. We've also got members in South Africa, Canada, Australia, etc., etc. And in total now we have well over 3,500 members. Some of those, approximately 10% of them, are what we call our ambassadors, who are individuals that are particularly closely aligned to our work, and they're people that we are especially proud to have as part of our community. We have a strategy for driving change, and that strategy for driving change is all about bringing together the thinking of two types of people. On one hand, those like myself who have a sense of passion and purpose for the changes that we want to see. And the second group, those that we characterize as having the power and the position to make change possible, by which we mean the regulators, policymakers, politicians. And we dream up all sorts of ways to bring people together to galvanize support for our mission and our vision. And tonight's event is one of our book club events. We're going to be looking at the book, The Whole Truth by Peter Crowley. Before we get to Peter, let's invite everybody to introduce themselves. Please do be as brief as you can, just name, organisation, job title and where you are. We're going to start off with Mr. Nigel Cairn. So Nigel, please introduce yourself. Then we're going to go to Mike McGrath, then Robert Lynham, then Andy Candy. Thank you, Nigel.
Good evening all. Nigel Cairns, tuning in from Devon. I've got an ongoing banking dispute of some 14 years, which has led me to become interested in the TTF, and looking forward to this evening's session. Could I just say one thing? It's really good to see Robert here this evening. It helps with the balance of ages, because we seem to be a fairly aged sort of group otherwise. So well done, Robert.
Yeah,
Thank you.
Robert, well done for being young. Kerry, also well done for being young as well. Very good. Thank you, Nigel. We'll now go to Mike Lloyd. So Mike, please introduce yourself. Thank you.
My name is Mike Lloyd. I'm in Sussex. I have an ongoing dispute with my bank. I was victim of interest rate hedges that were enforced on me by the bank for 10 years. That effectively cost me my business, which had been running for 22 years. Never a problem until interest rate hedges came in, and it cost me in fees and extra interest about £2.5 million over 3 years.
Wow, thank you very much, Mike, for being here. That sounds absolutely tragic, it really does. Let's go to Mr. Gordon Neve, then we'll go to Mike McGrath, then young Robert, then to Jim Bignell. Gordon.
Hello, I'm Gordon Neve, calling from Edinburgh. My wife and I are victims of an HBOS Bank of Scotland rehypothecation fraud, after which we lost our home was confiscated, our life savings stolen, and me put out of business, and our pension fund destroyed by Clydesdale Bank. So we have a lot of problems with the banks currently, and I'm endeavouring to pursue what I believe to be the first prosecution of bankers in Scotland.
Thank you very much indeed, Gordon. You mentioned a word earlier, I think it was rehypothecation. Would you mind just spending a couple of sentences turning that into plain English for me, please?
Well, it's where a bank has pawned the title to the security by securitizing it and selling it as a bond into the Wall Street securities market fraudulently.
Thank you, Gordon. Thank you very much indeed. Mr. Mike McGrath, who was the inspiration behind an event we ran a couple of weeks ago, all about the Lloyds Bank scandal and why it really matters. Mike, could you please briefly introduce yourself, sir?
I'm Mike McGrath, Cardiff, South Wales, Lloyds Bank victim, and I support the TTF.
Thank you, Mike. You certainly
I've
do.
just ordered the book. I haven't read it, but I've just ordered it.
Okay, very good. Thumbs up from Peter Crowley. Young Roberts, I think we'll call you Young Robert from now on. Please introduce yourself, Robert.
Hello, I'm Robert. I've just finished an undergraduate degree in international relations. Next week I start an internship with the TTF, and I'm here tonight to hopefully learn a few things and get a better understanding of the impact that the financial services has on real people like everyone on this call.
Perfect, Robert. That was absolutely spot on. Thank you, sir. Robert's with us for the course of July, and we're very pleased that he and also Kerry, who's also with us this evening, is also spending some time with us during July. Let's go to Jim, then to Andy Candy, then we'll go to Mark, Kerry, and then Momadou. So Jim Bignell, please introduce yourself.
Hi everyone, my name is Jim Bignell, and I'm starting the responsible business movement with an objective, a mission of achieving responsible business becoming commonplace by 2030.
Thank you very much indeed, Jim. And we find ourselves very aligned with Jim's thinking around a particular topic to do with what we call the Global Financial Services Oath. We might mention that a bit later on. Thanks, Jim. Mr. Andrew Candy.
Hi, my name's Andrew Candy. Missold an interest rate swap in 2008 by my lovely bank HSBC. Pretty much caused catastrophic damage to my business and personal life as a result, and 12 years on still fighting for compensation from the actual acknowledged mis-selling of that product by the bank within a regulatory review. But as such, it's embroiled me with the Financial Ombudsman Service, the FSA, the FCA, and the whole corrupt cabal that have sought to cover this thing up, which Peter's book very clinically exposes from start to finish.
Thank you very much, Andrew. And for those of you that don't know, Andrew's got real skills and talents in relation to graphic design and all things related to it. And he has been very kindly helping TTF with some of our design needs. Thank you very much indeed, Andrew, for that. Let's go to Kerry Clark.
Hi, I'm Kerry. I'm a sociology student at the University of Birmingham. And in a couple of days, I start an internship with the TTF. And I'm sort of interested in conflict and corruption within society.
So we're especially pleased to have Kerry with us tonight alongside Robert as well. Let's go to Momadou Touré. Forgive me if I've not pronounced your name perfectly well, Momadou.
Hello, hi, Andy. No, that's fine. That was well pronounced. Yeah, my name is Momadou, and I'm a journalist with money marketing. So I'm here to cover the event. So nice to meet you all.
Thank you very much. We've been especially pleased with the coverage we've been getting, Momadou, recently from money marketing. I think Lois has written some really good stuff recently, and I'm very grateful that you're here with us tonight.
Yeah, thank you.
Let's go to Mr. Barry James next, please.
Hello. Is it introductions? I'm really sorry for being late. Okay, so I'm Barry James. I am co-founder of the Humane Economics Project, and we're shortly going to be running a symposium on the remaking of money, because that's what's happening. The pound is going to be remade digital, so are all the other currencies around the world, and the implications for society, well, the title says it all, and thanks to Andy, which is, we have the battle for the digital pound, and we're going to be exploring exactly what that means and all the implications. Is that okay?
That's more than okay. It's lovely, Barry. Thank you very much. Why don't you take the chance to pop into the chat the date, time, etc. of that event, and restate the title so people can let us know if they'd like to attend it in due course. We're now going to, again, forgive me if I get the pronunciation wrong, Kiana White, please.
Hi, my name's Kiana. I'm an analyst. I work for Peter Crowley.
Oh, great.
At Windsor Actuarial.
Thank you very much. Lovely to have you with us. Okay, let's now go to Peter, who not only is going to introduce himself, he's also going to talk about his book. He might spend maybe 10, 15, 20 minutes or so talking about the book. We'll all feel free to kind of interject and raise points and questions as we go. We'll make this as conversational as we can. We're due to finish at 7 p.m. UK time. We might run over a little bit. I'm pretty relaxed about that. Mr. Peter Crowley, over to you, please. Tell us all about your book. Thank you.
Right, I think the book's been out a couple of years now. Basically, for anyone who hasn't seen it, it runs through what actually happened and the sort of the philosophies behind swap mis-selling. And at the end of each explanatory chapter, I've put a case history in there, and I think the last one was Mike Lloyd's.
It was.
Yeah, so you know, there's a number gone through there. There may well need to be an update, but I'm currently working on some other analysis which shows, which in some ways is just as interesting. It shows not only how a scam gets going, but what happens afterwards, and the cover-ups and the problems. And I think the problems with this are far more widespread in society than we like to believe, and a number of the problems are now coming to the fore. I mean, for example, the post office scandal, where people have actually been sent to prison in order to support a dodgy system that effectively the civil service has supported. There are a number of organisations that work in a very dishonest way, and it's important to find out why they work in that way and what possibly we could do to address it. But for today, I'll sort of just run through some of the discoveries. I think they're quite surprising discoveries I've made since the book was conceived and published, and areas where I think big questions still need to be asked. Shall I go into the slides now, Andy?
If you'd like to, yes, you've got them at your end, I imagine. And also, if I hope you're planning to just tell us a little bit about you and your background and what motivated you to get involved in writing a book about this topic as well.
Okay, that's fine. Yeah, I'm an actuary. I've been practicing for about over 20 years as a fully qualified actuary, and I've been in the profession for around about 40. So I know my way about long-term financial issues. The last sort of external employment I had was in the pension review, and I spent about 5 years looking at mis-selling, which was quite horrendous and destroyed a number of insurance companies that had been household names when I grew up. And that was all quite traumatic, because I knew a lot of the people who were senior actuaries in those companies, and they certainly were, you know, dishonest people. And for finding them to have been dragged into this sort of stuff, and then you know, big companies destroyed, it almost in the same way as the equitable life suddenly disappeared, and in a way that so many people thought, you know, there can never be anything going wrong with this company. It started in 1762, etc. Yet in the space of about 7 or 8 years, 3 or 4 men in key roles managed to destroy it. And I had a letter the other day, because I had a small policy with them, and I mean, they're now called Utmost, and they're some sort of Mickey Mouse outfit. God knows who they are. But I mean, it's quite galling, because, you know, I joined the profession in 79. And I could see things going wrong. Anyway, after the pension review, a friend of mine around about 2005 asked me to have a look at something RBS was trying to sell him. And I did a few quick sums on it. I was quite sort of naive in those days. But even then, I said, basically, don't touch it. You know, it'll be good for you in about 0.5% of cases. And in 99.5% of cases, you'll get screwed. So he didn't take it out. Around about 2010, the Bully Banks organisation got together, made a bit of noise. And I thought, what on earth's going on here? You know, and suddenly realised how widespread swap mis-selling was. There was a chap called Jeremy Rowe involved, who was quite a good orator and got a large group of people together. I I was working in a block of small serviced offices that had been set up in Victorian days. That was rather like a sort of a business equivalent of Hogwarts. There are all these lovely little offices all over the place, all differently shaped, all with Victorian twiddles and bits and pieces. Right up in the top attic was a chap called Gary Kendall, and Gary ran a operation called CDO Squared. Very clever people up there giving advice to banks on CDOs. Now Gary knew his stuff, and Gary was also, one of the guys with the most integrity I've ever met. I heard him giving some Ernst & Young people such a good kicking that I was thought, I wish I could have done that. But anyway, we formed a partnership. We did a number of reports to help people go to court with these things. Unfortunately, I think there is no duty of a bank to underwrite a loan in any way that has integrity. And this is an area that I think dangerously some economists are getting involved in, and so we could end up doing the whole thing again. But in the sort of financial world in which I'm familiar, this thing was a total con, and it couldn't sustain any kind of banking system. And there was some insanity going on, because it's like you run a business, you sell a product, and then you sell products that destroy your main product. So what on earth are you doing? It's a sort of financial cannibalism. You've got sort of Polly put the kettle on, and then you've got Suki take it off again. Tweedledum and Tweedledee. It's absolutely bonkers. And the bonkersness only came, really emerged to be about, the 2016, 2017, when I saw a note from Her Majesty's Treasury on interest rate hedging. And I suddenly put 2 and 2, 4 together. I said, these guys don't know what they are doing.
I'm going to ask Andy Candy a question. Andy, there are a few people on the call who may not know what an interest rate hedging swap is. Would you mind giving us a plain English explanation of what that is, please?
A plain English explanation of what a swap is. Best of luck with that one. There's too many to... I don't think there is such a thing. I'm not being trite in that I'm laughing in that I think even after 12 years, I still couldn't provide you with an explanation, but you've got fixes, you've got collars, you've got caps, you've got structured collar. I mean, they're endless. They're complex designated investment products. SMEs shouldn't be engaging in them, and banks certainly shouldn't be mis-selling them to them and effectively rendering SME as a professional counterparty for the purpose of doing so. I mean, the whole thing is an apparent fraud from start to finish. So I'm not sure I could provide you with an explanation short of what Peter's book does that will describe it in in simple terms, as it were.
Okay, thank you. For Robert and Kerry's benefit, an interest rate hedging swap, the basic idea is that interest rates go up and down. Sometimes the movement in interest rates could cause problems for businesses who have products that they've bought that in some way linked to the price of money, the interest rates. So the basic idea is to use means to mitigate the risks associated with the fluctuations in those interest rates. That's the basic idea. It means that, for example, one party might say to another party, if you buy this interest rate hedging swap, it will mean that you will protect yourself from unnecessary risk. That's the fundamental idea. But as Andy has just so rightly said, there are all sorts of shenanigans that go on around that make it quite potentially quite disturbing.
The banks specifically sold these as protection against risk, and they absolutely do not do that. They actually put you from the frying pan right into the fire as far as risk is concerned, because you're actually put into a position where you take on more risk. You're not actually protected from it because you understand the structure. So the problem with describing it as a protection against risk or interest rate raises is that's not the function of it. It's actually an investment product.
Absolutely.
Not an insurance product, and it doesn't come under ICOBs under the regulations.
Thanks, Andy. We ran an event a little while ago about the interest rate hedging product scandal. I'll pop a link to the chat to the recording of that. Meanwhile, let's see if we can jump back to Peter. And Peter, don't worry if you can't get your slides up. Oh, it looks like you can. Go for it. Thank you very much.
Okay, thanks, chaps. Treasury Supremo, Her Majesty's Treasury, the most powerful financial unit in the UK government and probably in the UK. First Supremo, this chap, Mr. Gus O'Donnell. Look, he's there with his jewels. He's been heavily rewarded for all his hard work. He was the head of the Treasury between 2002 and 2005. While he was there, he described the system that the Treasury had put in place, a set of requirements on the Bank of England regarding managing short-term interest rates. I'll describe that to you. 2004 speech to the University of Glasgow, macroeconomic policy, monetary policy. This is a bit whistle-stop, but bear with me. Hopefully you'll pick up most of it. UK's monetary framework is aimed at, oops, let me get rid of that bit up. Right, yes, aimed at achieving price stability and subject to that support the government's economic policy objectives, including growth and employment. Monetary policy by stabilising inflation helps to stabilise output and employment. All sounds good so far. The new monetary policy work based on the Bank of England's Monetary Policy Committee, which is the committee that sets interest rates from month to month, has consistently delivered inflation close to the government's target. So you want low inflation. And the way they do that is if things start getting out of hand, the economy overheats, they move the interest rates up, finance becomes more expensive, and that dampens inflation. The other side of it is if we get slumpy, they move them in the other way, and interest rates become cheaper and everyone starts investing again. This success is particularly beneficial for those parts of the UK that have suffered mostly from microeconomic volatility in the past. Having sat in as Treasury representative on the MPR, I can say that it takes care to take fully into account economic conditions in all parts of the UK when setting monetary policy. These are the is it 7 or 9 guys, I forget, who sit there with that chap Andy Haldane and various other economists who talk about the economy, and you've now got Andrew, what's his name as well, Bailey. Bank of England has 12 regional agencies covering the whole of the UK. Agents keep in close touch with local businesses, people, labor leaders and trade and regional associations provide monthly advice economic develops in relation to the monetary policy. So they do a lot of research and they talk to a lot of people in the economy. It's not just a little bunch of economists in the clever house saying how they think things should work. The agents also play a very active link role between monetary policy committee members and business and other contacts in the regions. And then a bit about how good low inflation is, which we all know. So I think we all get that. So these are the guys that are varying the interest rates and moving them up and down. And we get a pretty good picture from O'Donnell of how it's working. So in other words, what he's saying is that businesses should borrow at floating interest rates, because then it's better for them, the individual businesses. If you've got a business and there's a bit of a slump, so your sales are dropping, then they're very nicely going to drop those interest rates. So you have to pay less. So there's a sort of a matching process. However, for the UK economy as a whole, when the economy booms, if it starts over booming, then they're going to push the rates up. Now, obviously, that's going to hit your profit and loss account, but you're not too worried because your sales are high, so you can cope with it. It just means expansion is a bit damp. So what they're saying is floating interest rates are safe. Right, phase 2, Treasury Supremo number 2. This chap, Lord Nicholas Macpherson, Treasury Supremo 2005 to 2016. Under his reign, pretty early on, they issued this application note and interest inflation rates in PFI contracts. Forget the PFI bit, because the important thing here is the use of language. And he basically goes on about interest rate hedging. Now, if you think about it for a bit, this is very strange, because what they're actually saying is that rates are, this floating interest rate is a nasty risk, and you have to do something about this nasty risk. Right, and what he's saying is interest rates can be a significant risk, blah, 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 various approaches. Most PFI projects use debt whose interest rate has been fixed. So he is now plugging borrowing at fixed interest rates. So he's saying that fixed rates are safe. So put these two things together, and we're saying that Macpherson's interest rate risk is what O'Donnell describes as what the Treasury devised to remove risk. This is insane. So what happened? People did Macpherson hedging at the persuading when their banks pushed them into it. The economy crashed in 2008. The Bank of England did O'Donnell hedging, and all the swaps jumped up in value and made all the businesses worth a lot less. We had a mega bailout needed. A load of Treasury money was poured into the banks because the banks were then insolvent. The Treasury never admit they were wrong. So all they did was to squeeze the banks behind everyone's back, which we're all now aware about, with the net result that businesses got smashed up because they needed to get money to pay back Macpherson. It was a bit like the mafia. You ain't got the money, fuck you, pay me. Read any book on the mafia, you'll see how they work. So basically, after that, imagine I'm a business borrower and I want to minimize my risk. Do I opt for O'Donnell hedging or Macpherson hedging? It's a bit of a poser, isn't it? And if I'm risk averse, I think, well, these banks obviously smell a bit, they're crooked. We even got RBS, which is in the Treasury's hands, and they're showing this bloody idiocy. When they get into trouble, they'll find an excuse to bust my business up, and they've got more expensive lawyers than I can afford. So the answer is, oh, hang on, maybe I should go for floating rates. Oh no, they're crooked as well. Andrew Bailey has told me he's decided to kill LIBOR, so floating rates aren't any good. You know, I've thought about this, and I'm just not going to borrow any money. I'm not going to do those developments. I'm not going to expand my business. I'm not going to do this, that. So basically, I'm not going to borrow. And if people don't borrow, interest rates go down because it's supply and demand. People want to sell loans, but no one wants to buy them. And the economy floundered, and it floundered all between 2008, 2016. I won't show you the technical graphs. Anyone who's interested, let me know. But I've been tweeting some of the more technical stuff recently. Have a quick whiz through and let me know. And what did we get? We all voted Brexit, or enough of us voted Brexit to show we don't like this economy. It's pretty crap. Now, the one department that really hated this was the Treasury itself, but sucks to them because they've been stupid. Here's a graph showing interest rates. Around about the 80s, Thatcher time, it was around about 10, 12%. Then we had Major time around about 7. We had Gordon and Tony Blair around about 5. Now it's dead. It's flat in the water. There's no other explanation for that rather horrible side of the graph, which basically means the economy is dead. And that was my last slide. Let's leave it on the graph, and we can move to questions.
Peter, thank you very much. That was very interesting indeed. I appreciate the kind of historical narrative and the chronology of who did what, when to who, and I appreciate the creativity in which you've explained some of that. Really interesting stuff. Could you explain one bit for everybody in case people aren't aware? So how would a bank go about effectively taking control or seizing the asset, the business, let's say? Well, what sorts of things would happen that would result in somebody who borrowed money from the bank ending up losing their business to the bank, for example?
Right. There are two methodologies really, and number one is centered on the ones where there was a swap sold, and which would be separate for the loan. That swap would generate a debt. So basically, the company might well break its loan covenants because the debt that was generated by the hedging. And then the bank said, well, you just turned around and says, well, you took the swap out of your own accord. You decided to take the swap out. We sold it, but you signed these things saying you're responsible. You've got yourself into deep water because you've basically gambled on interest rates. And then they break your covenants and you go into GRG, which goes through the relevant process. Some of the lenders don't have particularly clear covenants, in which case they just rely on relentless pressure, lawyers, etc., to try and grind you down. You get daily phone calls to, put you under pressure to give report on this, report on that. They're clearly trying to smash you down. And the third variant is what they call the tailored business loan, which is a fixed rate loan, which, funnily enough, not that long ago, every single bank loan was a tailored business loan, a fixed rate loan, because people didn't have floating interest rate loans. They didn't have the technology to be able to do it. But that was the days before derivatives, and derivatives formed this enormous market where everyone basically is expected to borrow at floating rates. So if you borrow at fixed rates, that generates a risk. You're putting risk back into the process, which is absolutely insane. But the banks did that because they got paid extra money, and then they could boost their profits and try and keep up with old Fred Goodwin, which is how the economy was being run. If you didn't keep up with Goodwin, your bank was overtaken, and you'd get taken over in the same way as NatWest got hammered in 2000. But basically, a lot of it was just basically the bank is bigger than you. And as anyone who's been to some of the House of Commons events knows, it was covered up by the Treasury, because you get a lot of people raising issues, and at the end of the day, you get the Secretary to the Treasury standing up and saying, "Oh, I note this, I note that, I note that," and they knew nothing would happen. There was a secret pact between the banks and the Treasury. As long as the Treasury got its money, they would just ignore all the MPs. So there was an enormous rift in democracy because of a Treasury that thought it was cleverer than it actually was. And that's why you've had a crap economy for 10 years.
Thank you very much. One more question for me, Peter, before we kind of throw it open, and perhaps those on the call who've experienced the kind of impact that Peter's been talking about in generic terms, perhaps you'd be happy to share a brief summary of your own cases. But before we go to those that may want to do that, Peter, from your point of view, what does your insight into the world of banking say about the culture of banking? Has the culture changed much since those days? And is there a risk that something similar but different could happen again?
Taking your last point first, there is certainly a risk, because basically dodgy banking got both the banking industry and the country into a mess. There has been a marked reluctance to actually admit that the people who were in charge then were responsible in some way for getting it into a mess. The system has basically been about protecting people at senior levels rather than finding out the truth and sorting things out. We might get into another mess, but the problem is we've never really got out of this one. If you look at that graph, you'll see that interest rates are still flat. Now, we've had the events of COVID and we've had Brexit, which has obviously pushed rates down, but they don't account for all the rubbish in there. A number of financial commentators have basically said that the aftermath of the crash is worse than either of those two, and it certainly left the economy in a far weaker state to be able to deal with those factors. The thing that scares me is that the same old faces are still in charge. We've still got Andrew Bailey at the top of the Bank of England. He was in charge of the Financial Conduct Authority, which was basically a puppet organisation, particularly useless in my view. No one can get to grips with this sort of stuff because no one understands it. But the danger is that the people who might restart the economy are now expected to be sophisticated before they can borrow money and feel that they're being safe, because the bank will say, oh, once you get to a certain size, you're sophisticated, you can weather out the problems with interest rate swaps, and nobody can. So you cannot have a banking system with interest rate swaps. The two don't work. It's like trying to sell thalidomide for childbirth pain. It just does not work.
Thank you very much, Peter. Really interesting stuff. Could I please invite those that have experienced something along the lines of what Peter's been describing in kind of hypothetical and generic terms to share a little bit of an insight into their own experiences. Mike Lloyd, if I can go to you first, if you're happy to, please, sir, just kind of reiterate, as you did the other night, the short and sweet of what happened to your case, because it's virtually unbelievable, but I know it to be true. So please tell us a bit about what happened to you in your business.
Basically, we started our business myself and my ex-partner started our business in 1990. We grew from one site gradually over a period of 10 years. Very careful about what we did. We didn't want to take any huge risks. So we had nice growth in business. From one site, we got it up to effectively 22, 23 sites by 2006. Now, the first big loan that we took was in 2001. We got an opportunity to take over 7 leases that we occupied on a long-term lease agreement. Our landlord offered us the freeholds, and it was an absolute no-brainer because we were going to pay less by buying them than we would be paying in rent. So at that time, Barclays decided that they would support us. We had other freeholds, so we had a nice loan to value situation, so they were perfectly happy to support us. And they sold us something which was called the Mini Max, with a base position and a cap. So it's like a cap and a collar. So we were, as far as we were concerned, floating between these 2 points. And we continued to grow the business very successfully. We turned over about £8 to £9 million a year. We employed a couple of hundred people, full and part-time. Circle comes round, and after 5 years, we had to have a new banking agreement. Barclays, our relationship manager introduced the man from Barclays Capital to come and see us, to tell us what we needed to do. And he was telling us all the time we were out of the money. We didn't really get it because it was, about 0.2 or 0.3%. It wasn't having any major impact. So man from Barclays came to see us, and he made a wonderful presentation to us, telling us that they were of the view that interest rates were going to go up. We didn't quite agree, but anyway, it didn't make any difference. We were put into a situation that we had to enter into a 10-year interest rate hedge to protect the business against interest rate increases, which is what he presented to us. We weren't given an option. We weren't given an opportunity to have anything such as a cap. And of course, a cap would have actually done what it said on the tin. Anything over a certain rate, we wouldn't have paid. So as far as we were concerned, it was the same situation. We had a floor and a ceiling. We were going to move between these 2 points. We just carried on, never thought anything of it. As far as we were concerned, we were protected. At that stage, our loan to value was probably something around about 55, 57% loan to value. So we felt very comfortable. If anything went wrong, we could sell property, bring down our borrowings, and continue as normal. Or so we thought. So when we got to March 2009 and interest rates, as we all know, collapsed, the first thing we knew about the product was Barclays took £27,000 from our account at the end of April. So we were a bit confused about what that was all about, and we were told, well, this was the product that we'd enter into, and it was the swap agreement. So what do you mean? Well, when interest rates fall below with the floor, which in our case is 4.1%, you pay the difference between where we put your base rate and where the 0.5% is happened to be. Now that actually cost us £27,000 a month.
A month?
A month. Not a year, per month. So all of a sudden we were in a situation we were paying about £340,000 a year extra interest as a result of the fall to 0.5%. So clearly we're also at that point in a recession, and things are extremely tight, as we all know. People will spend as little as they can to try to survive themselves. So we were then introduced to a lady from Barclays Business Recovery Unit who came to see us and told us what she would do to help us. That was all very nice, but the first thing she did to help us was tell us that we represented a risk to her, and that was because of the swaps. So she decided to increase our lending rate as well by another 1%. So at that point, we are actually now paying £300,000 as a result of the swap fall in interest rates, And now she's also increased our lending rate by 1%, and we had £7.5 million of the borrowings. So I've now got to find another £75,000 on top of that. So we're now paying over £400,000 a year more interest than we were
before,
in February of 09. So we're then absolutely hammered because she tells us she's going to introduce a business recovery team to us who were beggars trainer. And beggars are going to come and look at our business, look at our forecasts and decide what we needed to do about it. And of course, we had to pay the fees for beggars trainer, which further had an impact on our cash flow, as you might imagine. And the fee for the independent business review was just under £50,000, which of course we then had to find. She then also introduced a specialist company to us who were pub specialists. Myself and my partner had been in pub trade for the best part of 70 years between us, but we obviously didn't know what we were doing. But this company came in and they were also going to charge us £25,000 a month. So a month. We were absolutely destroyed by the costs of the extra costs for advisors that the bank insisted we had to have. They decided that we would exit all our lease properties, which were then 7 properties. And as a result of that, again, we're starved of cash. And we then have to pay to our landlords costs for dilapidations, which we can't afford because we're being screwed. We surrendered all the sites and all the F&F that we held in those sites, which probably cost us another £100,000. We also then had to pay all the redundancy costs for all the managers and staff at the premises. We were told we would sell 4 freehold properties because there was a valuation done on the properties that we held. Interestingly, we actually managed to sell 3 of the 4 properties at or above the bank valuation. And following administration, surprise, surprise, none of the properties ever sold at valuation. They were always well under. That aside, we sold 4 freeholds and we asked if we could use the money from the receipts from the sales to buy ourselves out of the swaps. This is a lady from Barclays Business Support Unit. And I quote her words, "Excuse me, young lady, that is my fucking money, not Barclays Capital. No, you can't." So we sold 4 properties for 1.7 million, and it made absolutely no difference to us because all it did was starved us of cash. It just made our original mortgages less, but we still had the liabilities for the product that we were put into by Barclays Bank until 2016 and further. So Barclays decided that they would refinance our business. We were in trouble with HMRC because of the fact that we hadn't got the cash coming in. We spoke to HMRC to advise them the situation. They were quite prepared to listen to what we were proposing to them. So Barclays decided they would refinance the business, which they offered us in 2011, in December 2011, and it took 6 months to arrange that. Now I now know why, because of course in February 2012 the 6-year statute of limitation came into place. That was very convenient. So it then cost us £1,025,000 to buy ourselves out of the product that Barclays put us into. And that was at the end of May 2012. And 6 days later, we received a letter from Barclays asking us to pay the entire amount that we owed back to the bank, which was some £6.6 million. And that was within a week of refinancing the business to the tune of £1,025,000. Clearly, we couldn't afford to do that. We couldn't afford to go anywhere else. And then on the 13th of June, administrators arrived at our office and told us to go home, effectively. And we lost the business. No other reason other than the interest rate hedges that Barclays put us into. We went from a situation that we had properties worth 13.5 million and we owed Barclays 7.5 to absolutely nothing at all.
Mike, thank you so much for giving us that very, very clear and vivid and precise account of what happened. Allow me, if I may, please, Mike, to ask one simple but potentially quite painful question. If they hadn't sold you what they sold you, what would be your situation now, do you think?
If they hadn't sold us what they did sell us, we wouldn't have had the costs before administration. PS, the business advisors were Begbie's trainer before administration, and guess who the administrator was? Begbie's trainer. And Begbie's trainer, we asked to prepare a CVA for the bank, which HMRC were perfectly happy to look at. But they didn't do that. Now, is that because Begbie's knew they were going to get £650,000 or £700,000 in fees for the administration? That aside, we wouldn't have paid out £2.5 million in costs pre-administration. We would have had a business that was turning over still sensible money and was making an EBITDA around £650,000 to £700,000 a year. So let's say 9 years since that happened, or £6 million worth of EBITDA. We had assets and property that was worth, at that stage, after we'd sold stuff, probably £11 million. We would now be in the situation that in 2021, there'd have been 4 years left on the loans, so we would have paid off an awful lot of that. We'd probably have a mortgage of around £1.5 million to £2 million, probably about, I don't know, 14 to 15 million pounds of the property. So I would estimate cost as something in the region of £18 million. And the worst thing of all is the stress that was caused by this.
Yeah,
cost my partner his life. I have got no doubt about that. He was a fit 66, 67-year-old man. And at that stage, where is he going to work? How is he going to pay his mortgage? What can he possibly do to survive? Nobody's going to employ a 66-year-old ex-director of a pub company. He's doomed. And he died as a result of it.
Mike, thank you. We run a lot of these events, you know. We've run a lot of these events, and time after time after time, I find myself hearing things that are just so shocking. It's difficult to really come to terms with what's happened. In terms of your position in the law, have you got any kind of case to say, look, we were missold this thing?
No, at the end of the day, Andrew, the products that were sold, to us were structured cap and collars. And as far as the FSA were concerned, they made the announcement that those products were missold, and a company, anybody who had forced these products onto them would be put back in the position that they would have been in had they not been sold. Right. And that was in June 2012. Now, obviously, the magnitude of the potential claims were colossal. They then introduced a criteria of sophistication. That sophistication criteria said that if you employed more than 50 people and your turnover was more than 6.5 million, you were sophisticated and you wouldn't qualify for compensation. Now, bearing in mind, I'm running a chain of pubs. I might have somebody working for me 8 hours a week, 2 nights a week, a cleaner. I could have had 49 people and paid them £1,000 a week, and I would not be sophisticated. But because I had 50 or more people, I am. And therefore, there was no compensation payable to me. They now, as we all know, have got the situation with BBRS, which I have applied to. They've now brought in a situation again, whereas staff numbers don't come into it. I now qualify on the turnover, but of course, there's now a situation that we're now looking at the assets that the company held. And they're now looking at the position of gross assets. Well, can somebody ever tell me when a bank ever worked on anything in a gross basis? They don't. So therefore, I'm not sure now whether I'm going to be classified as a, what's the word I'm looking for? A concessionary case. I haven't got the foggiest idea, because they're saying I have £9 million worth of assets, but I owe the bank 7, so therefore I've got £2 million worth of net assets. They're not working on that basis, they're working on a gross basis. It's absolutely absurd.
So,
no other way I can describe it.
We'll open up to others shortly, and we're going to run over, folks. Obviously, if anybody needs to jump off at 7 o'clock, then obviously do so. But if you want to stay, please do stay. But this is it's too kind of rich in insight to just want to skimp over. This is just incredible stuff, Mike. So, from your point of view, is the system as a whole just basically trying to find excuses to not pay compensation to you and people like you, in plain English?
Andrew, in December 2008, Barclays Bank wrote to me with a classification to tell me that I'm a retail client. Right. And before that, was I a private client or what was I? They write to me to tell me I'm a retail client. And then, of course, when the magnitude of the costs that are liable for the banks to pay out, obviously because of RBS and their bailout, and the effect that was having on, it was going to have on the Treasury, they classify me as a sophisticated client. They never wrote to me between December 2008 and June 2012 to tell me I'm a sophisticated client. It's absolute nonsense. And on the presentations that they put to me, they also make a disclaimer that the products they are selling are for investment professionals only and will only be entered into with such persons. I'm not an investment professional. I'm a guy running a chain of pubs. I'm a retail client.
Thank you, Mike, so much for sharing this insight with us. What a ghastly experience. I think what you've just done, sir, brilliantly is really brought to life the point made in Peter's book here, how banks weaponize lending. I mean, 4 very, very powerful words that you've just brought to life so superbly, how banks weaponize lending. Mike, thank you very much indeed for sharing that with us. Would anybody else like to give a brief account, please, of your experiences or anything else that you'd like to add to what's been said by Peter and Mike so far?
Could I jump in with just one very quick sentence, please, Andy? I get the impression the BBRS is just basically like a holding pen. The idea of setting it up is to wait people out. There's no chance of any sensible compensation out of it. They're just there to wait for you. I gather their boss has resigned because she realised it's crooked. I personally wouldn't waste 10 minutes with them, from what I've heard from people. But you guys may.
Reality is, Peter. I don't have any option because I can't afford. 6 years or more has gone by. I can't afford any legal costs because they know that we spent £50,000 on legal fees within a month of us going into administration.
Yeah,
they know I can't afford it, and that's my only option now. So
no, I do understand. It's a horrible thing to say, but I've seen that you've seen the tweets as well.
Yeah, what'd you say?
Don't hold out hope. I've seen how this game works.
Yeah, there needs to be, from my point of view, there needs to be a proper independent review of what the hell's been going on, because it's people marking their own homework, isn't it? Yeah, the banks have been caught doing something wrong, but somehow they've got so much influence and lobbying power that they end up with their hands on the steering wheel, so to speak. They end up in a position to control what's actually happening. There's no sense of natural justice here. You wouldn't, would you allow, let's imagine you got burgled. Would you allow the burglar to be the person in charge of deciding what happens to you as a consequence of you being burgled? Of course you wouldn't. It doesn't make any sense at all, but that is how the system seems to be working.
Exactly. There's a philosophy which I call the world restarts, where people come along and say, well, let's pretend that everything that happened before doesn't matter. And it's like the civil servants, they're working for a certain administration, and then someone else is elected, so they can pretend the world restarts. Ferguson is on the record. If you listen to something called the austerity audit, he tries to come up with that, and he says, oh, of course, the crash wasn't a public sector crash, it was a banking crash, pure and simple. That is the biggest load of rubbish I've ever heard, because basically those funds were used to fund high levels of spending. It's not just Labour that do it. Tories have done it in the past, but everyone wants to come up with free, cheap money and hope that they get away with it. And eventually they don't. And you can't just turn around and pretend, oh, nothing. Let's forget what happened in the past and restart, pretend it didn't happen. Certainly, Macpherson didn't restart when he set up the Asset Protection Agency and UK FI. No bloody way.
Thanks, Peter. I made a note in the chat that we've got an event on Monday. It's about the FCA's consultation on a consumer duty. Now, I haven't got time to go into explaining why, but that's a really important event. The short and sweet is, we think that if there were to be a proper, legally enforceable duty of care that the financial sector had on the consumer, so the consumer could literally sue people if they were mistreated by them in some way, we think that would be a powerful route to justice. And because it existed, it would make the financial institutions behave better, because they know that it would be relatively easy for them to be sued if they were to do something wrong. We think there's some interesting stuff going on around that consultation. I don't want to elaborate on it now. If you can find yourself with time clear from 6 to 8 on Monday, then drop my colleague Alexandra Zitkus a note in the email I gave in the chat to come along to it, because it's going to be a real eye-opener. We've got Lord Stevenson of Balmacara speaking. We've got Ian Mitchell QC speaking. We've got Baroness Tyler speaking, and various other people. And this is probably the most important regulatory consultation there's been in decades. And if the FCA succeed in bringing in a mild consumer duty rather than a full strength duty of care, it will be a huge missed opportunity to protect consumers from harm. And we will be very, very suspicious in relation to what the forces were behind the scenes that led to that dilution of what Parliament has actually said it wants the FCA to do. No time to elaborate on that further, but let me throw it open. Please just wave at me if you'd like to share a point at this stage. We've got a couple of hands went straight up. Mr. Andy Candy, we'll go to you first, then we'll go to Nigel. Andy, over to you, sir.
Yeah, just a brief thing to give a bit of context to the comment that Mike made about being excluded from the FCA review. The sophistication that were illegitimately brought in, arguably by Sajid Javid, our new health minister, and it was covered in an article in the Times by James Hurley, effectively resulted in 5,000 SMEs being excluded from that review scheme. And conservatively, they estimated that saved the banks somewhere in the region of, well, north of 15 billion. So if you take that across the statistics that Martin Wheatley came out with at the time, where there were in the region of, I believe, 50,000 IRHPs that had been sold to SMEs, but somewhere north of 60,000 that had been sold as tailored business loans, where the interest rate hedge was hidden within the loan documentation. So you were looking at north of 100,000 UK SMEs that have been embroiled in this fiasco. When you also consider that these products came with hidden credit facilities, and that the banks utilize these hidden credit facilities to hypothecate or rehypothecate, which I think Gordon mentioned earlier when he was introducing himself. The rehypothecation of securitized assets in the US is limited to 1.6 times the amount of the asset. In the UK, it's unlimited. I think Steve Middleton touched on this in the TTF IRHP review and in more detail. But even if you just take those 5,000 excluded SMEs, north of 15 billion in redress potentially due to those, how much that was potentially rehypothecated by the UK banks in that scenario alone. And it will blow your mind as to the extent to which this scandal and a multitude of others, Lloyds HBOS, RBS, GRG, all of these banks have been engaged in covering this up with the assistance of Treasury, because through the asset protection scheme, through their management of RBS and through influence with Lloyds, this whole thing, you can see the potential scale for it. And it's astonishing that the blatant, and I mean, Peter's book sets it out in crystal clear detail. If you there's a lot of information to digest in there, but it gives a very clear account of how this, as he says, as commercial bank lending to small businesses, unsophisticated small businesses, was weaponized. This was just a mass asset stripping of UK SMEs to refill the bank's coffers at the behest of Treasury. Daylight robbery, absolutely front and center. So I'll leave it there. But
Andy, thank you. And isn't it rather ironic that we've actually got, people who've, spent blood, sweat and tears building businesses, sometimes family businesses, sometimes businesses that have been around for generations, made all kinds of sacrifices to look after those businesses, to cultivate them, to grow them, to nurture them, to protect them, to frankly love them, to find them being effectively stolen from them in a very, very devious, conniving way, to enable the banks to get hold of money so that they could repair their own balance sheets as a consequence of a global financial crisis caused by, guess what, malpractice, malfeasance, misconduct and mis-selling in the banking sector. So you end up paying the price kind of twice over. I saw Barry put his hand up just then. So Barry, let me go to you quickly, then we'll share it out. Thank you, Barry.
Yeah, let me just kind of endorse what you just said, Andy, but also say this: it's theft. It may be legal theft, but it's a form of pillaging. What's happened here, and it's no comfort at all, I'm sure, and I'm sorry about that, because these things matter and they destroy lives, even when they don't kill people. But it's a widespread pattern across the economy. I'm sorry, but it is. And that doesn't make it right. It actually makes it widespread. And part of the mission that we're on, by the way, is to understand the roots of that, which I think we now do, and to work out how we change the ethical climate, how we change the culture of decision making. Because I'm going to stop now, but just to say this, that we've traced this, we know it's happened, we know how it's happened. We need to work out together, as people who've been victimized and refuse to be victims, how we change it. But, that doesn't change the pain. I get that. But, let's work together to fix it.
Thank you, Barry. And just to briefly add a bit of weight to some of the points you very clearly made there, I'm going to share my screen. I'm aware, of course, that a lot of you know what I'm about to say. I'm talking about Violation Tracker. So Violation Tracker is a US database. If you haven't seen it any before, I'll put a link to it in the chat. And it basically captures information about all the infringements by companies against US authorities. And just to quantify that, 490,000 civil and criminal cases from more than 300 agencies with penalties of $669 billion. Remember that figure of $669 billion, because when you ask the database to tell you, give me a list of the worst offending industries at the top, financial services is the worst offending industry. $332 billion worth of fines, roughly half of that 667 figure that I mentioned a moment ago. In other words, the financial services sector is as bad as all the rest of these industries added together. This goes to show there must be something particularly wrong about the financial services industry. And this is why the Transparency Task Force exists. We are perfectly aware that there is something seriously wrong with the financial services industry. And if you click on what I just clicked on, you get the detailed breakdown, the worst offending organizations, then the individual cases. And if you scroll down the page, you'll see recidivism. The same organizations being caught doing the same thing over and over again. Absolutely right. Over and over again. So this is a deep-rooted cultural thing. The regulators' fines don't make a difference. It's a cost of doing business to the banks. There is something horrifically wrong here. And that's why we believe in the Justice Louis Brandeis saying from 1914, when he wrote the book other people's money, all about infringements by the banks. That's why we know that sunlight is the best disinfectant. That's why we've worked very hard to bring about, or to help bring about, a UK equivalent of violation tracker. It's all there. I'll put a link to this in the chat, and you can play with the database if you haven't seen it before. Mr. Nigel Keynes, your turn, sir. Thank you.
I would just like to say that I strongly endorse everything that Andrew Candy was saying a little earlier as well. It was, I don't think there's anybody that could disagree with anything that he said there. Well done. But the point I wanted to focus on just at the moment was the point raised by Mike Lloyd a little earlier about the BBRS, because that currently very much concerns an awful lot of people.
Yeah.
Now, the point I want to make is the credibility or the legitimacy of the BBRS, or rather the complete lack of both of those things, its credibility or legitimacy. In stark contrast to the FCA and the forerunner of it, the FSA, and the Financial Ombudsman Service, which were all created under the Act of Parliament, FSMA 2000, which effectively was enacted through a democratic process. The BBRS is the creation of UK finance, in other words, the banks, and it has no parliamentary legitimacy whatsoever. It has the endorsement of the current Conservative Party through John Glenn, and also through the strong endorsement of Mr. Bailey at the Bank of England. But that is not Parliament, and it has no powers. But it's purported to be on an equal footing, and it's presented as being on an equal footing as the organisations that I've just mentioned, the FCA and the Ombudsman Service, where clearly it's a completely different animal altogether, although it is masquerading as having credible authority. And I think we ought to make perfectly clear that it has not got any credibility. The only credibility it's got has been given by John Glenn and the Conservative Party at the moment, not Parliament, no act of Parliament at all, and by a matter of extraction, no democratic origins to its legitimacy. So I think you get the drift, hopefully.
We certainly do. We certainly do. Thank you so much. Let me invite a few others to share their thoughts. So Stephen Barker, lovely to hear from you, sir. Please do share your thoughts. Thank you.
Thank you. I apologise for being slightly late, and I was trying to finish Peter's book. And I have to say, as a record of conduct by the banks, it fits exactly my experience in the last 10 years. And it is 10 years now since the business I owned and traded successfully was effectively seized by the banks, Lloyds Bank, originally Bank of Scotland, and disposed of. Everybody got paid apart from the shareholders and HMRC, as it happens. So the process is exactly as Peter describes in his book. It's a very authoritative and informed narrative, which has got wide application. And what this proves is, because I've never met Peter before and spoken to him, but quite clearly he's garnered all the information in that book from a wide source base, which only goes to prove that this is not a one-off situation. This is not a peculiarity, an aberration in the otherwise highly respectable banking community. It is fraud on an industrial scale. And you would have to look to some fairly extreme circumstances in other countries. The methods adopted have been used in other countries against their own population for political ideology, not just financial return. And unfortunately, whilst we would all hope that the agencies of the state would respond effectively, the reality is they won't. It's quite a well-known fact that police forces up and down the country have learnt from the Stansfield experience. They can't stand budgets of 7 million to investigate a fraud, let alone 1,000 frauds in their areas. And they're under-resourced for, I would say, more heinous crimes of murder and public disorder. They haven't got time to go looking for fraud or indeed responding to complaints of fraud. That's a problem. When governments subcontract, shall we say, ministerial department responsibilities, like the Treasury have done through the FCA, although the legislation, and I would say the 2000 legislation is a robust piece of legislation and came out of a previous decade of abuses within the financial services sector. The problem is that if you subcontract the responsibility for the enforcement of that legislation to an agency like the FCA, which is not independent of government, it's not like the judiciary, it's under, shall we say, the control of the Treasury. And the Treasury has its own agenda. And the FCA has failed to use its powers provided in that legislation. Failed to use powers which enables them to enforce restitution. Section 382 of the Act. Why has it failed to do that? Well, because somebody in the background is deciding that that's not appropriate. Because if you do it once, you will open the floodgates to thousands of claims, and that's not going to happen. So we're faced now with the situation of relying on certain committee MPs, certain members of Parliament and their committees, like the All Parliamentary Group on Fair Banking, certain news outlets in a sort of very limited way, I have to say, and organs such as Private Eye and City Slicker to accurately report on what's going on. Mm-hmm. Now, I don't know how there is a resolution of all this. I think the reality is that people like myself and Mike, unfortunately, they've lived the experience, but I don't think we're ever really going to recover from it. And I don't think there will be a sense of justice. The only reason I would recommend anybody to go into the BBRS is to find out how it works. And this will be just another example after the 2012 FSA voluntary arrangement with the banks turned out to be a complete failure for most customers. I suspect everything that's been said about the BBRS may turn out to be true, but it may not, but we'll find out. And if we don't participate, then they haven't got the caseload and we haven't got the evidence of its failure or success, as the case may be. So I wouldn't give up on that, I would do it. The alternative is the courts, and I have to say the civil courts are not at all friendly to our situation. And their main excuse is that the financial services sector is a regulated sector. It's not a matter for the courts. So we go round in a loop, and that's a problem. And finally, I think the criminal system, and I've read some very good private criminal cases that have been taken, but the people in question could afford to take it. They've been very successful, and they've gone for fraud. That's worked out okay for them in the sense that the banks have settled very readily. But the bank needs to know that you've got the money to take it forward. So there we go, just some observations. But great book, Peter. Thank you very much indeed. I've enjoyed reading it this afternoon.
Pleasure. Okay. I'd like to add a quick point if, unless there's anyone else who wants to speak.
Go for it, Peter.
Right. Well, very, very quickly, a lot of the funds that were basically that were the bank's spurious profits up to 2008 were used for public spending. So this was a political maneuver in order to squeeze money out the banks to boost public spending. It's a very dangerous practice, and in my view, it'll only lead to disaster. Andy said, what's going to stop this happening again? The roads I see us going down, and I will be putting this into writing, that there are two mechanics. One is to turn around and say, oh, look, there's lots of rich people, let's take their money, and then we'll all be rich. Doesn't work. Number two is the economist's route, which is a bit more subtle. And at the moment, a lot of them are relying on one expression, which is, do you know, banks create money when they lend it. Has anyone heard this?
Yeah.
I think it's a load of bollocks. It's very dangerous bollocks. And that's the sort of thing that's going to get us into another crash, because the philosophy is, oh, we can, in that case, we can lend it to nice people and we can all be nice and super. There's a website called Positive Money, which I'm going to be ripping apart in the next few months. Read it, take your own view, but I think that's the route to disaster. And a lot of people are trying to jump on that bandwagon because they want to try and, so my cleverness will feed you. My brains will feed you. Your brains won't feed anyone. Your money feeds people. That's the bottom line.
Thank you, Peter. Interesting. I'm going to share with you an idea, folks. The real question, of course, and I guess what the book's designed to do is to provoke the question, okay, well, what should we do about it now? And I definitely don't have any kind of magic solutions to this, clearly, but there's something we can do, and that is about building political pressure for change. So this is the all-party parliamentary group on personal banking and fairer financial services. There's a healthy clutch of MPs in it, cross-party, and basically this APPG is all about trying to improve the way the financial system works. In December, it issued a press release, which I'm going to share with you now in the press. In December, it issued a press release, which was picked up by a couple of places. For example, Money Marketing. I'm specifically choosing Money Marketing here because we have a guest from Money Marketing here today. MPs call for debate on making FCA fit for purpose. So there is definitely growing pressure on the Financial Conduct Authority to up its game and become fit for purpose. It's a good article. It's a good bit of coverage there. The reason I'm mentioning this is because the all-party parliamentary group is actually the secretariat to the all-party parliamentary group on personal banking and fairer financial services is the Transparency Task Force. This is one of two all-party parliamentary groups that we run. And I'm pleased to say, if you're not already aware, that the all-party parliamentary group has decided to carry out a call for evidence about the Financial Conduct Authority. And if all goes to plan, that call for evidence about the Financial Conduct Authority is going to start next week. So what this means is, if you want to, you will be able to share your thoughts about the Financial Conduct Authority through that APPG's call for evidence. And we believe and hope that that is going to create, the evidence is going to create even more momentum around this big question. What's it going to take to get the FCA fit for purpose? The more scrutiny there is of the regulator, the less captured the regulator will be by the City of London forces that quite clearly do operate. And that's one of our strategies to try to make this system, the systemic problem, start to evaporate over time. It isn't going to change overnight, but it will change if there's persistent pressure to change and if we use Parliament as the engine for that change. We're going to start bringing things to a close shortly, folks, but I want just to invite anybody that hasn't yet said what they'd like to say to do so. Robert, I'd love to ask you a question, sir. As a young gentleman who's very, very new to these issues, I would not be surprised, Robert, if you're saying to yourself, I just can't believe this. You know, until like 2 weeks ago, I was completely unaware of these issues. And you would have been quite rational to think that people saying the sorts of things that we've been saying tonight were, you know, conspiracy theorists or nut jobs in one way or another. But please just speak from your heart. What do you feel and think about what you've heard tonight?
I suppose it's It's absolutely shocking, really, because it's not mainstream news, and it's something that should be. And whilst I haven't really understood all of the ins and outs of the technicalities of how it all works this evening, one thing that really has come through is the kind of the human impact of it, and the devastation that these things cause. And yeah, without organizations like the Transparency Task Force, it really kind of begs the question, who's standing up for the victims of these sorts of issues. So I came to the event on Monday about the mortgage prisoners, and I think someone put in the chat there was a parallel with that. And there's,
yes,
yeah, I absolutely agree with that. I don't really understand that fully either, but the difference between the two, the similarity between the two, sorry, is really quite striking.
You've made your points supremely well, Robert. Thank you very much indeed. Thank you. Okay, let's start bringing things to a close. Let's go to Mr. Peter Crowley for any final thoughts from Peter. Then we'll check in to see if anybody else would like to say something, and then we'll bring matters to a close. Peter Crowley, you've written a great book. Clearly, it's on topic. It's very relevant to the work of the Transparency Task Force. Any final thoughts from you, and in particular, what are your plans to try to make a difference? Because what comes through loud and clear in your session today, Peter, is that this stuff really does irritate you. It really does annoy you. You know it's not the way it should be, and you seem like a man who's quite committed to trying to do something about it. So, what are your plans? What's your agenda for driving change, Peter?
What's my plans? Banking. I have problems looking at it. There has been so much resource thrown against good practice and goodwill. I'm afraid I have to be negative. The crooks have won. Interestingly enough, they've done themselves a lot of damage. What this, I think, boils down to is something that's a far broader issue, which I call disresponsibility, which is when things go wrong and no one's responsible. People wriggle out of the way, but they also set up systems to make sure that nobody is responsible for the problems. And then when the problems happen, and they always do, there isn't someone with a grown-up mind there to basically take them on and say, look, this needs fixing. Everyone runs away from it, and then things get worse and worse. And when the shit finally, post office is a good example. You had a crappy IT system. No one ever checked it. No one, the BEIS will blame the post office. The post office will blame the BIS. The two are interlinked. Everyone goes to work for the other one, but no one ever takes any responsibility. People got sent to prison. They had to take responsibility, and now it's all blown up. And this was predictable, probably from when Labour got in 1997, and they scrapped the development of the system, and they banged it into place. Now it's not just you can't just blame Labour. All parties do it, but there is no APPG for large computer systems, nor is there any kind of select committee. No one's interested. Everyone jumps on the bandwagon of new technology and blah blah blah. But it's the big computer systems we look at, and no one is even starting to look at them. So we just know more of these things are going to crawl out of the woodwork because we've got this incredible disresponsible system, which starts with the civil service and just goes round and round in circles. And civil service isn't the only disresponsible organisation. There's about I'll be addressing about 5 or 6 when I actually get the next book done. But it's certainly one that needs probably lays down the rules for disresponsibility that the others follow. But very quickly, it's secrecy, arrogance, history. You've got to have a history in your organisation, and you've got to have aggression. Those are the 4 ones, and then you get the other odds and ends, which I've touched on and we'll go through. But it'll help you. You can recognise these organisations, and you can avoid them if you possibly can, because you know what will happen if things go wrong.
Peter, thank you so much. I think we should bring things to a close there. I'm coming away from tonight's session with even more determination that something has to be done on a macro level to shine a big bright light into what on earth is going on here. It's an absolute outrage, isn't it? It's a national scandal that this is quite literally, it is being allowed to happen. We do not have the dynamic democracy that society needs. We do not have a democracy that is allowing the ordinary person, the ordinary citizen, he or she, that family, that business owner, being protected from sharks. And there are a lot of sharks out there. We'll bring it to a close there. Can we please just show our appreciation to Peter for his session tonight? Thank you very much indeed. Very, very good. Good stuff, folks. Okay, we'll wrap it up there, folks. Thank you very much indeed. Good night.